A lot of that downgrade for the US economy is because we're expecting Main Street in the US to have to pay higher prices for lots of the stuff they previously imported from China and other countries.
The International Monetary Fund has announced its World Economic Outlook. The message, in short, is that if you were worried Donald Trump had taken a sledgehammer to the world economy, you'd be right. Growth forecasts have been slashed, inflation predictions are up, and while the US will be the worst affected, we haven't got off scot-free. The one source of comfort for the government is that in 2028 and 2029, the UK's growth forecasts have been upgraded ever so slightly by 0.1%. Simon French is the chief economist for Panmure Liberum and a columnist for The Times as well. Simon, what are your main takeaways from this?
Well, good afternoon. I mean, this is no big surprise. I think we've known that the IMF was going to be pretty negative on not just global growth, but UK growth for some time. So this is confirming that the headlines that we've seen based on a huge economic uncertainty coming out of the United States with spillovers around the world will translate into those growth figures. I would ignore the Treasury line that growth has been upgraded in 2028, 2029. It's so far off in economic terms to be largely irrelevant. In the near term, though, what it tells you, though, is that the uncertainty will probably mean less business investment, and the risk of tariff retaliation and friction to trade will slow down consumer sentiment.
Is it possible to know what we would have been talking about if Donald Trump hadn't announced his tariffs?
You can't replay or sort of try and sort of do a counterfactual for economic history, but I think the IMF would have been trimming their what looked pretty bullish growth estimates for the UK at the start of the year in any case, because the global economy had been slowing, but it has been now slowing much, much faster since the ill-fated Liberation Day tariff announcement and the impact that that has on global trade and sentiment.
I'm interested in what you say about the fact that we should largely push aside this growth forecast for 2028 and 2029. But would it not be simply true that this is being put in there as a headline because it is the first good thing that we will be able to see on the horizon? And if that is the case, then actually we really are holding our head in our hands at the moment, aren't we?
Well, look, context is important, which is 1.1% growth, which is what the IMF are now saying for the UK for this year, is still faster than Germany, France and Italy, the nearest comparable economies. And that's undoubtedly what the Chancellor will say at interviews later, is that comparable European economies are struggling more. The reason why that 0.1% is so irrelevant is it is so within the margin of error and indeed policy uncertainty it'll be revised at least 8 times before we even get to 2028. It's kind of an irrelevant number.
Right. What might turn this around, if anything?
So within the look, I've only had 5-10 minutes to try and work through the details, but within the forecast is an expectation from the IMF that the Bank of England will cut interest rates by more than had been perhaps feared by some holders of household debt, mortgage debt, credit card debt. So maybe 3 or 4 more interest rate cuts. That will take some of the pressure off debt servicing costs. The other thing that's in the forecast, and not just the IMF, but also from the European Central Bank at the back end of last week, was energy prices are considerably lower now than they were just a few weeks ago. And if you're filling up your car after Easter, if you're paying the energy price cap after July, you're going to see some quite when it next gets revised, you'll see some quite considerable falls in those key costs. Energy costs, we know, are a visible cost for households. It really impacts sentiment. And if those are coming down, you're likely to see consumers feeling a little bit more optimistic about their spending power.
Right. And presumably, Simon, if we do better in a deal with the US than the rest of Europe, we would start to pull away from those other European countries in terms of our growth?
Yes, look, I found the commentary around the Liberation Day tariffs and the fact that the UK was levied at 10% and the EU at 20%. It was a little bit too polarised, depending on whether you're a Brexiteer or a Remainer. But it is, I think, objectively the case that outside the European bloc, the UK can negotiate, if this is a series of negotiations with the Trump administration, more nimbly, more advantageously for the UK than it would as one of 28 countries. So maybe it's taken 9 years to get there, but that looks a little bit like a Brexit dividend.
And give us your very long view on the state of the global economy at the moment. If an alien was to land on the planet and say, "How are you doing, kids?" what would you say?
I'd say it's not normally this sunny, but no. What else would I say? Look, I would say that this is a pretty clearly now a generational shift in the US's approach to its partners. And I use the word partners rather than trade partners or military partners or political partners. I try and use that advisedly because across all those parameters, it's open for question. So the stability that the West has largely had since the end of the Cold War is open to question. And that has big political ramifications. Where are you going to invest your money? I mean, let's make it really practical for Times Radio listeners. 50% of UK pensioners' savings are exposed directly to the US economy, either the stock market or US government debt. That means what happens there has dramatic ramifications for our incomes in retirement, our wealth in retirement. And so the alien landing comes into a period of extraordinary flux of the type we haven't seen for at least 35 years.
Very good question from one of our listeners, Mike. Will we really get interest rate cuts when inflation is so high?
It's a good question. Mike's asking the right one. Yes, I think so. So I think in May, so next month, the Bank of England are signalling that they will cut interest rates, despite the fact that the current rate of inflation is still above the 2% target. But of course, the Bank of England has to make policy on a 2-year view. It's not making policy based on the inflation rate now. It's based on what it thinks the economy will face in 2 years' time. And if all these rather downbeat stories crystallize, and the IMF have added grist to that mill today, then the Bank of England is dealing with pretty soft demand, pretty soft ability to set prices, and therefore should be making financial conditions, therefore interest rates, rather easier for businesses and households to deal with.
And elsewhere in this report from the IMF, the US is the worst off amongst advanced economies. It says growth is now expected to be 1.8% this year, down from the IMF's estimate of 2.7% for the US in January. Now, that does seem to be quite a mighty fall.
Well, tacking it back to Mike's question previously, the reason for that is that while we can debate whether tariffs and trade disruption will be inflationary or indeed disinflationary for the UK, because, of course, we could have dumping of pretty cheap Chinese imports into the UK economy, which brings down prices. In the US, it's very clear. In the US, tariffing your nearest and biggest trade partners will be inflationary. And therefore, I think there is much less of a question mark on what will happen to prices. And we've seen, haven't we, in recent years, that when inflation goes up, consumers tend to be pretty cautious. So a lot of that downgrade for the US economy is because we're expecting Main Street in the US to have to pay higher prices for lots of the stuff they previously imported from China and other countries.
Is it interesting to make a direct comparison to China, where the IMF says that China will grow by 4% this year? That's down from the previous estimate of 4.6%. So less of a drop, which presumably reflects the fact that China's economy may be able to withstand tariffs by tapping into other markets quicker and faster?
That's the intellectual answer, and therefore I commend you for giving that one. The less intellectual answer is...
I think there's a but coming there,
There is. I'm an economist,
Yeah.
So of course there's a but. It's on the one hand. On the other hand, China make up their growth numbers, and therefore we don't believe anything that comes out of the Chinese Statistical Authority. So the IMF, who are trying to guess what the Chinese Statistical Agency are going to report, have made a slightly downward adjustment to that guess, but I don't think it tells us anything intellectual about the Chinese impact. I would say that looks a bit too bullish given the impact that's going to have on what is almost $500 billion worth of exports out of China to the US that are basically port bound at the moment because of this huge uncertainty on the scale of tariffs.